Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsuranceRisk.com. Today, my guest is Ryan Gibson. Ryan is the co-founder, president, and chief investment officer of Spartan Investment Group. Ryan has organized over $200 million of private equity for Spartans projects across the country. And in just a minute, we're going to speak with Ryan about real estate investing and development. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple of things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our investors, our listeners. And also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Ryan Gibson. Welcome to CRE PN Radio.
Thank you, Darren. Thanks for having me.
I'm looking forward to our conversation today, but before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, started off actually as an airline pilot and met my business partner in Washington, D.C., and we started with a residential development. And now we have a portfolio of a little over 500 million of self-storage, a little bit of office, retail, industrial, spread across 13 states. And our focus today is on finding existing self-storage properties that we can add value to, either through expansion or increasing rents or revenue management, or we sometimes build from the ground up. So we'll find a development site and that will fully entitle and build the construction from the ground up and then lease up the facility. The other thing that we focus on and specialize in is construction. So we have our own construction company that will build self-storage for others and also builds up our portfolio as well.
Awesome. So if I understood right, the asset class you guys focus on is self-storage and office. Is that right?
Primarily 100% self-storage. Sometimes the self-storages that we buy come with some ancillary things like office, retail, industrial, et cetera. But the majority of our focus is building our free up storage in our storage platform.
Got it. And the two strategies I heard you say, and I was hoping we could get into today, is to kind of compare. If you're buying an existing property, I'm assuming that's a value add strategy where you're looking to increase the value. Is that am I spot on with that, or is that am I missing something?
Absolutely. Yeah. We buy existing properties and our main focus is to deploy really solid revenue management. And that would mean taking a property that's underperforming or it isn't quite built out all the way. Like we have extra land we could build additional units on, and we will take that property, implement ancillary income like tenant insurance, we'll raise rents to market, we'll expand the existing portfolio, basically our property, and we'll basically increase that NOI so that we can improve the value of the facility over time. That's 95% of what we do.
Got it. And when you're buying an existing property, what are some of the I guess your due diligence? What are you looking for? Is it management? I mean, you mentioned the opportunity to build out more, but is management kind of one of the easy to fix, or is it rents, or is there a particular thing that you look for, or is it kind of like you dig in and try and find the the golden egg or whatever that'll make it, make it work better?
No, that's a great question. There's three things really that we look for on an existing property. One, we look at the market, and if the market has rents that are below the rents that that facility is collecting, we analyze how much below the market that is based on a like kind property. That way we know when we buy the asset that we're already below the market in rents. But also what's really important in that is that the occupancy of the market is strong and the rental rates are strong, so that we can justify raising rents on our current customers. So that's kind of like the easiest win of them all. The second thing that we look at is what is the future potential of that market in the sense of how much population growth is coming, what is the access to population centers, what is the general consensus of where that market is headed. Maybe there's 10,000 homes being built within a mile, or there's really strong job or income growth. Those are variables that we strongly look at to make an investment decision, surrounding a particular asset. That kind of plays into occupancy and rents below the market. And the third thing that we look at is really what other value can we add to the facility? So a lot of ways to make extra income is through tenant insurance sales. We get 70% of the revenue on the insurance that we sell our tenants. And we require all facilities to have tenant insurance. They don't have to use ours by law. They can use whoever they want, but they have to have insurance to do that. So that's one big ancillary thing that we can add right away. The other big one is that if it comes with vacant land to expand and there is unmet demand in the market for additional storage, we will go in and we'll make sure that we can do the expansion that we're intending to do. And that comes in the due diligence process. We do a site survey. We look at the environmental study. We look at, can we build what we're intending to build here? And, that's usually done through the assistance of a civil engineer. And then those additional units will add a ton of value to the property overall. So those are kind of the three main things that we're going to look for in due diligence.
Got it. And you mentioned the insurance and kind of the rents. Are you guys employing any kind of systems? I mean, is it management systems as well, or is there any kind of automation? I know I have talked with others, and it seems like that's kind of a big thing. If you get I'm just kind of curious.
Yeah.
Do you guys, is that?
Yeah. The nice thing about self-storage is I feel like property technology or prop tech is something that actually scales in self-storage. So most facilities, if not, 95% of them have the capability of being fully automated, where you can integrate the revenue management system that we use into the property so that it speaks to the gate software and it could switch on and off access based on late payments of rents and other things like that. So the industry in general is highly automated. I don't think it's unique that Spartan is going out and highly automating these facilities or implementing these softwares. Now it's rare, but sometimes we find a mom and pop that just has been doing it by hand, handwriting the leases still. They're not hooked up to the internet. Some facilities don't have internet at all, or even sometimes running water or things like that. And they're just doing it because this is how they've always done it. And there's no reason to go spend money on the software. But the industry has made it widely available to use this type of revenue management software that provides a lot of scale and automation. And so absolutely we do that. But I wouldn't say that makes us really unique necessarily. I would say that that's more of an industry trend that most operators are doing. And it scales because you can really start dialing in collections, having delinquent customers, make sure they're paying because they're not being able to access their units. That gets their attention pretty quickly. So it's a really fascinating space because of the automation that's available to the consumer and the operators.
Got it. And did I hear you right? 13 states is where you're currently operating?
Yeah. Yes.
And is that, obviously you do your due diligence like you talked about on kind of demand and that. But do you have people on the ground then that are with your organization, or do you have third party subcontractors that do any management for you, or how are you set up that way?
Yeah, currently we're mostly there's only one facility out of 60 or so we manage all of them ourselves. So our employee count is, well north of 100 employees, I think 115 employees now. And we have our own employees deployed at each individual property across the country. So when we go through the acquisitions process, our employees are traveling to the site that will be overseeing that facility. So we know exactly what we're getting into before we buy the asset. And I think that's an advantage. One of the many advantages of having your own in-house property management is you have the ability to know that your employee is going to be there, that you have boots on the ground in each of these markets that really help us, drive good performance. So that's a really, really big piece of that. Plus, the principles of the organization, myself and Scott and Ben, we travel to the sites and see these properties for ourselves as well. It's really important.
Yeah, there's no substitution for seeing it up front in person. So your investment model, are you guys primarily doing what am I trying to say here? Are you doing syndication? Are you doing is this your own money, or how are you raising capital, or how are you
Yeah. Every property is a syndication.
Okay.
So we like to target, both types of investors, those investors who want to replace hard-earned active income into passive income. So we have our Spartan Storage Income Fund that we raise capital for, that goes out and buys existing properties with cash flow. And that's a very specific target for people that want to see that monthly income, because we do monthly distributions. That provides the investor with the upside potential and the monthly cash flow. It also has got a component of depreciation, so the investors are getting losses, tax depreciation in the year that they invest, which is great. The other thing that we do is a growth fund, so Spartan Storage Growth Fund, which targets ground up developments. So those are for those investors that, maybe they've got a good balance of passive income, or maybe passive income isn't as important as taking a little bit more risk for a lot more reward. And that's the growth fund, where we go and we find difficult to build sites or entitlement projects where we can go build from the ground up and add. That's where we get the most value out of an investment. So we give our investors sort of those two options. And then we also do a debt fund where if investors want to just have no upside, but know they're going to get that 8 to 9% monthly coupon, regardless of what happens, and be in a higher position or with some collateral, the debt fund provides that vehicle for them as well. So, and of course, we always put in our own money. We're typically putting our own guarantee on the loans, and our employees also invest in our projects as well. So we're very aligned when it comes to, having our share of skin in the game.
So tell me, on the debt fund, do you use that on your own deals then, or do you guys go out and lend money to others, or how's that work?
Currently, it's just on our own deals.
Yeah.
In the future, we may expand that to lending to other operators, but really the issue with going to other operators at this point is having an investment committee that can approve the worthiness of the borrower, and we're just not quite feeling comfortable with doing that yet. So as of right now, it's to help fund our own projects, and especially in this interest rate environment, it's become more critical to have kind of more control over the capital stack so that we can do more for our investors, which has been fantastic.
Yeah, I think you're one of the first that I've talked to that have. I mean, there's people I know do a lot of like note investing and that kind of stuff, but actually to raise capital as debt, as opposed to more of an equity side of things. And have you always been that way, or is that something that came about later, or how long have you been doing the
Yes.
debt fund?
Yeah. So we haven't been doing a debt fund in the past. We've been kind of a deal by deal syndication of private debt. And it's been very beneficial to our investors. A great example, we were buying an asset back in 2017 and the lender pulled out at the last minute. And as anybody knows, in a single asset syndication, so many things have to come to a head to make the transaction successful. You have to have the capital raised from the investors, the bank financing lined up, and all that comes to a point at the time that you're supposed to close with the seller. And sometimes that doesn't really line up as you plan. And having the arm to do private debt and the investors that have that appetite can be very beneficial to being able to close on time when you say you're going to close, or maybe even adjust the closing time frame up to be more competitive. And so we've been doing this since 2017, and it's been better. There's a litany of things that have happened, such as bank financing pulls out last minute, or the bank changes the terms a week before you're supposed to close, and you say, I don't really want to get stuck with this loan. I want to go somewhere else, but I just need a temporary loan for 3 months so I can close on time and comply with the purchase and sales agreement, but have the bandwidth or the runway to go find better terms for debt. And traditionally, if anybody invests in self-storage or has been an investor in self-storage, it's not the easiest asset to finance. And especially when you're doing these projects that are value add and have a construction component to them, or they're underperforming, or they're in a tertiary market, or you're an out-of-state operator, it's difficult to find financing exactly in the way that you've pro forma'd. So the private debt has really just opened up a lot more flexibility as our organization grows. So,
Yeah, no, that makes so much sense. I'm surprised I haven't heard others, you know, talk of it as much. And just the thing that kind of stands out for me is just the control, like you mentioned. You're no longer, at the whim of the bank that decides to pull out in the last deal, or it would seem to me it would give you a lot of security in the ability to control the closing and the deal. Now, when you put the debt on there, do you then, uh, once you get the property, um, operating at a higher level and the NOI increases, do you then seek to replace the debt and use it again, or is it a more of a permanent debt for the property through the fund?
sure. So it's the debt fund offers redemption. So if investors want to park cash for 3 months and then call it, it provides that liquidity. So we're constantly turning over the money and putting it into other projects as part of a debt fund allows. But also, if that liquidity comes back and we have a redemption request or an investor that wants their cash back, gives us that flexibility as well. So it's kind of a win-win for everybody. It's I don't want my money to just sit in my savings account and collect 0.002%, or maybe it's higher now, maybe it's 2% now. But at the same time, it also provides limited liquidity based on the redemption period and et cetera. So it gives us flexibility. We look to say the way that we've written the rules in the debt fund is if if all the redemption requests are fulfilled, then great, we can continue to go lend that cash to other projects. But if it hasn't been, then we can't continue to lend until all the redemption requests have been fulfilled. So it gives us that optionality to pay off an investor or roll it into the next project. So a lot of interesting things.
Got it. And I guess let me just be more clear. So I get the idea in that your ability to close, use whether it be the equity you've raised through syndication, or the debt fund for bring in the financing. But is there a point? Do you down the road, once the property, you have it up and running and operate at a higher level than what you purchased it at, do you then ever replace that debt, or do you?
Yes,
Okay. Okay.
100%. Yeah. So great example. We bought a property a couple of years back for about 1.3 million, and we put about 300,000 into fixing it up. Property was a disaster. It was like 14% occupied. Obviously, we fixed it up and leased up the property to stabilization, more than tripled the value, and then did a cash out refinance. And then the investors benefit because they get all their cash back tax free, and then continue to earn income from distributions on the property, just as they would prior to the refinance, except, just not as much because obviously there's higher leverage on the asset. But that's a great strategy that we have repeatedly used. In today's interest rate environment, obviously it's a little bit more difficult because you're going to be refinancing out probably some pretty healthy debt, lower interest rate debt. But we do plan to do that going forward as we feel and we've seen the predictions that interest rates will decline hopefully at some point. So
Yeah. No, I love that concept and that strategy. Again, to have the cash to close, to get your thing or your deal, operating at a higher level, and then to be able to refinance and recharge the line with the investors or return capital or whatever that might be. But that's a neat way you're doing it. As far as the operation of the properties, you mentioned that you've got people on the ground. You're buying these in a syndication model. What's a typical hold time for you guys on a property?
So we've seen hold periods go 2 years to 5 years typically. We project 5 years for pretty much everything we do. And we've seen properties mostly that what typically happens within 5 years is we send all the money back, whether through distributions or through a refinance or a partial sale. Maybe we'll have an asset with a car wash on the front or something like that. And we'll split the parcel and sell the car wash, send the cash back early. But our goal is to send all the investors money back plus a profit within 5 years. That's our goal in every syndication we've ever done. So we've been pretty successful at that.
Got it. And as far as when you're buying an existing property, the timeline from when you identify a property to close, what's a typical timeline for you there on due diligence?
Typical due diligence period depends on the asset, obviously, but I would say 60 to 90 days is pretty typical. 90 days being on the long end of things. Obviously, that property may just have more DD to do or more kind of a tricky situation or maybe a bigger asset. But you can see, due diligence has dropped. Due diligence period has dropped because of our team to as little as 30 to 45 days in some cases. But it really just depends on the third parties because you have to order the survey, you have to order the environmental, and we rely on those studies to come in order to conclude due diligence. So it really just depends on the third parties. But we've seen that due diligence period really get a lot shorter over the years because of our thoroughness and knowing exactly what we need to know before we close. So that's, but I would say 60 to 90 days to answer your question a little bit more directly.
Yeah, and then but even your ability to shorten that and your capital to be able to close, that's pretty impressive. What about what's an average timeline for you guys to take a property that you acquire, implement your strategies to where the property is, operational at the higher forecasted model?
So we always pro forma a decline in revenue, at least initially, because when you take over, you're always going to have a declining occupancy or friction. People walk into the office and they see a new person, a new uniform, new paint job on the place, and they don't like it. They don't like the change. But typically, we've seen revenue increase in as little as 3 months, and we've seen it take as long as a year. So I would say 3 months to a year is when we start seeing that benefit. If it's a really nasty property, it might take a little bit longer, maybe more on the year side. We bought a portfolio about a year ago, and we're just now turning it around. It took a while to just deploy all the capital improvements, turn over all the staff, get everything sort of in place, and the revenue is now increasing. And it's been about a year. But we've also taken over assets and done immediate rent increases. And we've seen the impacts of that effect within as little as 3 months. So it really depends on the asset quality and sort of the deal itself.
And as far as your capital improvements, you mentioned you've got your own construction crew or personnel. Are you guys deploying? Are you a general, or how are you hiring subcontractors, or how are you handling all of the work that you need to do in a value add strategy? Is that in-house, or is that are you subbing out some of the work, or
so everybody's a Spartan, from our project executive at the corporate level to our estimator, project engineer, all the way down to the job shack trailer is a Spartan. So we are licensed in the states that we do improvements in. We're a licensed contractor, we're a general contractor, but everything is subbed out. So we don't self-perform any of the subcontractor work, but we're doing all the general contractor work and serving in that capacity. So we do everything from the initial improvements to the expansions. So we'll we'll do everything from oversee the hanging of a camera to a multi-story building from the ground up.
No, that's awesome. Definitely, just have the more again control compared to relying on everybody else outside, and be able to assess the situation, the numbers you're getting, and figure out if you're getting a good deal or if somebody's trying to take advantage of you. That's good on you. So let's talk a little bit about the development opportunities. You've mentioned, or we've talked a little bit about buying existing property, figuring out there's some land that you can, expand the operations on. Have you guys done some just bare ground, no asset, no operations in place, and gone vertical from there, or has it all been on existing property with operations?
So we've done ground up development. We've done several, and we've taken some very difficult parcels and turned them into beautiful Class A properties. I was mentioning before we jumped on here, one that's just outside the Portland market, about 35 minutes southeast of Portland, in a town called Sandy. We built a really beautiful property there. Took a really useless piece of dirt, to be perfectly honest. It's if you're ever cruising out to Mount Hood, you'll see I think it's an Arco gas station right next to the Tractor Supply, and we're right into that little complex there. And we took this parcel that has wetlands in the back. It was kind of a stalled project from a developer, and took it over, got it the rest of the way through the entitlements or building permits, and built it. And we've also built property in the state of Washington that had been riddled in wetlands, required extensive approvals from the Corps, Department of Ecology, Fish and Wildlife, etc. And we've done things like rezone properties. There's been a property we built in Colorado, in Aspen Park, Colorado, that we had to use dynamite to blow up bedrock to put in a foundation. So I feel like the things that even the early on projects have all been just extremely difficult, from, the land that we had to work with, and the entitlements and zoning and permitting that we've had to deal with. We've done some very difficult projects. But what's great is once you get those projects built, they're in high barrier to entry markets. They're in markets where the competition is going to be severely limited in the future, so that that you're kind of walling up your fortress of competition. So while you pay a lot up front in brain damage and time and money, you also get the benefit on the backside, which we really like. So we do ground up construction, and we do very challenging entitlement opportunities.
Yeah. So these challenging entitlement things, a little bit I understand with that is just the time it can take to make something, or to get to the point where you've got permits and you're ready to roll. We were just talking about 90 days from identification to closing. What kind of timeline are you talking about when you identify a property for development? And maybe we should break it down from identification to permits to you've got space to rent.
I'm laughing because that's such a fun question to answer. Anywhere from no time required at all, because the permits aren't even, there's no jurisdiction. We call it the AHJ, the authority having jurisdiction. There's no jurisdiction. There's no building permit process. So 0 days to 5 years.
Yeah.
So it's everything in between. So, we were really getting really frustrated when we first started getting into this, because we'd hear people say, oh yeah, it takes 3 to 6 months to get a permit and a year to build. And then it's open. And then, we are in our project that, our first ground up development took us 4 years, and we call it 4 years, trees to keys. So from the time that
I like that, trees to keys. That's good.
Yeah.
That's
So
good.
trees to keys could vary. And it really depends. But again, we just built a facility in Tyler, Texas. We're literally not even in a jurisdiction that has authority over our permit process. We've got facilities and everybody thinks, oh, Texas is just an easy place. We have facilities in Texas that we built that we had to go in front of our hearing examiner to get a conditional use permit on. And now, just scheduling that hearing and getting in front of the board and, or the the planning commission, and then them deciding and voting and how long that decision takes, that could take 6 to 9 months. And then you could be ultimately denied or have to come back and clarify. Unfortunately, fortunately, those things have been approved and we've gotten pretty good at it, but it really can depend. And it really, in your due diligence process, I highly encourage you, of course, ground up development is going to have a longer due diligence time frame typically. But really, the important part is that we want to make sure that we can get all the government external approvals before fully committing to buying the land. We'll put up earnest money and spend a lot of money on the studies and things like that, but we don't want to actually own the land or be so committed to the property until we know we can do what we want to do. And we'll move as quickly as we possibly can to get to that decision point. So we're really upfront with our sellers that is our goal, right? Our goal is to build this thing here, and our goal is to move quickly to buy the land and get those approvals. So, but yeah, it really, the Sandy project, that was a 5-year development.
Really?
Yeah. The city didn't want it. They didn't want it. And in fact, after we had built the facility, they further restricted where self-storage could be built. So it's not something everybody thinks, oh man, I see it just popping up all over the place. Self-storage is in every single, neighborhood that I'm in, but especially in the Pacific Northwest, there's a lot of jurisdictions that are putting moratoriums on storage. They don't want any more of it, which is really, I think I know I'm in the industry, but I think it's a disservice because every American uses self-storage at some point in their life, typically, 1 in every 10 Americans. And, when you look at a city, we know exactly how much demand exists because there's heuristics, there's state, local, and really micro market heuristics that tell you how much demand there is. And when you restrict the supply, all you do is increase the price for the facilities that remain. So really, you're doing a disservice to the people in your community that need a self-storage facility. And most of the time, people think, oh, well, self-storage is just for people who have too many things. But I've polled thousands of people, at speaking events and conferences. And we also know our customers, we have, 30,000 plus customers. They use it for primarily 2 reasons. Number one, for business. So they're using it to, a real estate staging company or a sheet metal contractor or somebody who has an Etsy store, something like that, some kind of business, or they're using it because they have a life event. They move, they relocate, they downsize, they renovate their home. Somebody dies, they put their stuff in storage. Their family gets too big, they put their stuff in storage. So really, it's a life event driven business. And when you restrict allowing it to be constructed in a community, you're gonna just create price inflation like anything. Now, the other hand of that is if you build too much of it, then you then you reduce the pricing, right? But that's kind of the balance, and that's some of the things that sometimes are in our favor as operators and sometimes go against us.
Yeah, no, the supply and demand thing and the political landscape is always kind of a dynamic that it seems like there's good intentions for whatever reason that they're putting out there, but I don't think that they always have a good understanding of the market and how to solve the problem. And it's unfortunate because it's in a lot of different asset classes, not just self-storage. I mean, you can look at, housing,
Absolutely.
and
Yeah.
stuff. And it's just, but it's it for whatever reason, it's a riddle that seems to just be a constant. And, then there's, the source of the problem that they identify is not necessarily the source of the problem, but it's more of a restrictions that they put on the marketplace. But another time, another conversation.
I think summarized and with that is, affordability is a person-made problem.
Yeah.
And it's zoning. At the end of the day, you restrict what you can build and where you can build it, and you create affordability issues. So I digress.
Yeah. Well, and I'm kind of curious, this kind of leads in or comes from that is the zoning. Do you find that as you get further away from a metro area, is it typical? I mean, you mentioned like zero time to 4 or 5 years, whatever kind of thing. is the zoning typically, is it very specific about self-storage, or is it, um, is there, I mean, is there a lot of resistance to it outside of the Northwest?
Yes and no. I mean, there's certain markets, that will restrict it, especially like, resort towns and highfalutin areas. I would say three ways to bucket what you're going to encounter. One, little to no zoning or very generic allowance in a commercial zone. So if the property is commercial zoned, you'll be able to go into the zoning code and you'll see that self-storage is a permitted use under that zoning jurisdiction. That's pretty typical, out in the rural areas that you'll be able to do that. The second thing you'll encounter, that out of the three that I would say is you'll the self-storage will be allowed as a permitted use under a conditional permit. So a conditional use permit or some kind of special use permit, something that you have to go in, and it's not an automatic approval, but you have to sort of justify to somebody what you're about to do. And then I would say the last thing you encounter is it's it's not allowed, or you have to have a rezone, based on the property you're trying to do. So maybe it's a residential property, or maybe it's zoned a certain way, and you've got to get it rezoned into a commercial, or rezoned into allow for self-storage. Or you might find that even if you are allowed to build self-storage here and you are in the zone, there's a moratorium for another year. So, or there's some kind of restriction in that zone. So it's really important to understand kind of what you might expect to find in a market. And that always starts with just going down to the city and saying, I have this parcel, I have this site, I want to put self-storage on it. Obviously do your homework a little bit on the zoning and what's allowed, but just go get the temperature check from the city. And that's usually done through what's called like a pre-application hearing, or some kind of a preliminary hearing where you can kind of get all your chips out on the table. And you don't have to have design plans or spend a lot of money on an architect with that. But the more you kind of know kind of what you want to build and what you want to get out of it, the more you'll take away from it. So I think kind of the better prepared you are from a pre-app meeting, the more you'll kind of take away with what you can do.
Yeah. Now, if you've got a, partner in the project, or if you've got somebody's going to try and keep you from doing it, makes a lot of sense. Hey, let me ask you. So you mentioned kind of the return, the opportunity if you're doing the value add strategy, that the returns kind of quicker, and people are able to, if they're wait, this isn't exactly what you said, maybe, but kind of
That's okay.
what I interpreted was that if somebody is kind of more on a right away, they're looking for a return, that the syndication model and the value add allows for that. Whereas, but you also made it sound like that, the opportunity, like you mentioned the one deal where you bought it for like $1.3 million, put 300 in, and then were able to triple the value and return all the capital and do a refinance and all that. How do the returns compare with the new development, as opposed to some of the value add strategies?
So
Or are you able to? Go
yeah,
ahead.
obviously, past performance doesn't predict future results, and this is just a projection. Do your own due diligence. I would say the projected return on a kind of existing property that, kind of stands to just have some slight, tweaks to value add and revenue management, you're going to see 14 to 19% annualized returns. So that includes all the money that you might receive from cash flow and all the money that you might receive from the potential sale. So that's a range that we give our investors. So 14 to 19%, with cash flow being between, usually typically starting in the 4 to 5% range and increasing to the 8% per annum range. And then that we kick that out monthly. And then the rest of the money coming from the eventual sale of the asset. After we make those improvements, property's producing more income, and thereby the valuation is higher. The growth fund or the ground up developments, where you're taking raw land from scratch, maybe getting a really good price on the raw land, and really doing a lot of the sweat equity work through getting those challenging entitlements and permits and building, you're going to see those returns stretch into the mid 20s. So you're going to see that 22 to probably 27% projected annualized return. No cash flow. I always like to stress to investors, when you build something from the ground up, it's not producing any income for at least 3 years, typically. If you had a fully entitled site and you could put a shovel in the ground, a typical size facility, it's going to take you a year to build it. Then it's going to take typically 30% leased per year. So if it's going to take, and your break even's usually right around 60 to 65%, it's typical. It depends on your capital stack and all that, but typically 60%. So when you think about a year to build and then 2 years to get it to 60% occupancy, you're looking at no cash flow for 3 years. So, but you've built a tremendous amount of value. Your cost basis, or what it costs you to get to that point, is going to be typically considerably lower than what somebody would be willing to pay for that asset at certificate of occupancy, like right when you open or when you lease it up and stabilize it. So there's a wide range of exit strategies in that model, but there's no cash flow. And there's an expectation to make low to mid to maybe even high, 20% return range on that on an annual basis.
No, I appreciate you doing the comparison there, because it's always been kind of curious and always thought there was a opportunity for a greater return on the development. Do you guys ever do any redevelopment? Take a warehouse and convert it into self-storage, or like an old retail box or something like that?
We haven't done the work ourselves to do that, but we have bought a Macy's that was converted into a self-storage. It's one of our largest properties, 180,000 square feet, 1,100 units in Fort Worth, Texas. We bought a Macy's that was part of a mall, and that was converted into self-storage. So we look to do more of those, but we haven't done as much as I would say I'd like to. I think there's a big opportunity in that still. Some of those parcels are, they don't have enough demand, or the expectation of what they would sell and how much money you'd have to spend to fix it up to convert it is still kind of out of balance, because if you're buying like a really nice main store that could be repurposed into a Whole Foods or something that is going to get really good cash flow, the sellers are going to expect to sell that asset for what kind of retail at Main would trade for. Likewise, if you're buying a junk Kmart that went out of business many years ago, it may have gone out of business for a reason. So,
Right.
And it doesn't necessarily equal self-storage demand. So even if the building is super cheap, it might not be in an area that's going to have self-storage demand. So you got to be really careful. A lot of those opportunities have been picked over or sold off if they're really well positioned, but there's still a ton of empty retail and grocery store chains and bowling alleys and skating rinks, and just tons of opportunities out there. You just got to really find what makes sense.
Yeah. No, I just love the opportunity, or the idea of repurposing, as opposed to, knock it down, put it up, kind of. It seems to me like there's some infrastructure there that's worth something, but maybe, just the cost doesn't pencil to make it work. But anyway.
Absolutely. Yeah.
Hey, Ryan, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies that we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And when avoiding or minimizing is not an option, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is, a risk transfer vehicle. And as such, I like to ask my guest if they can look at their own situation. It could be the economy, the Fed, political, whatever you view as the biggest risk. If you can identify that and let us know what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Ryan Gibson, what is the biggest risk?
Yeah. So I would say your biggest risks are external threats. Things like cap rate expansion, property values declining. You really can't control that. Interest rate risk, et cetera. But I would say my focus that I'd like to share is 5 main things that I look at in underwriting a deal. And I can do this in 10 seconds. I look at revenue growth year over year, and is it reasonable? Does the business plan identify if that revenue is achievable based on the market study that you've done, somebody else has done, or an operator's done? The second thing I look at is insurance. So insurance costs are not going down. So if you have not pro forma'd that your insurance expenses are going up, I usually don't like the deal anymore as much. The second thing that I assess risk, or the third thing, is property taxes. Property taxes are not going down. Property taxes are going up. And if you're not planning on property taxes at least doubling over a 5-year hold period, I don't think we've assessed the risk and the opportunity. The third thing I look at is expense to gross, or revenue to expense income. So EGI, expense to gross income ratio, I guess is another way of saying it, EGI. That's if you make $1 of revenue, what percentage will be your operating expenses? And so in self-storage, I'll look at a deal and I'll say, I expect to see between 35 and 40% expense to gross income ratio, meaning that if you're collecting $1, I expect to see 35 to 40 cents for that dollar in expenses and all your utilities, insurance, property taxes, all that stuff before debt service. If I see that number 20% or 15%, I don't think there's been enough assessment in the underwriting to really accurately depict the worthiness of that deal. And the last thing I look at is cap rate, because cap rate, everybody loves to think that they're the best operator, or they have secrets and things like that. But at the end of the day, cap rates drive the value. They drive the value. They drive the exit strategy. The market really drives where a lot of these assets can perform. And yeah, we can control and do our best, but that cap rate really makes an impact. I mean, $1 on a 6% cap rate means $15 of valuation. So yes, operating income can do that, but I like to see an investment where you can stress test it and that you can actually show the cap rate getting worse than what you bought it for. Not from your operations, but just market cap rate. So if you buy something going in cap rate at 5%, in today's market, I'd like to see that it can exit at a market cap rate of 6% and still be profitable. So when I assess risk, I look at those 5 things in underwriting, and I really kind of stick to my guns on that. That's how I can look at a deal and in 30 seconds know, have they adequately assessed the risk? Of course, there's tons of more things that you need to do beyond that, but those are kind of my 5 quick check boxes on any opportunity.
No, I love it. It's kind of simple and direct, and you can, if all those check the box, you can proceed. Ryan, where can the listeners go if they'd like to learn more or connect with you?
Yeah, sure. My email is ryan@spartan-investors.com, or our website is just spartan-investors.com. I'm also pretty active on LinkedIn. So if you connect with me on LinkedIn, I think I'm Ryan Gibson 01 or something like that. And in the Seattle area.
Awesome. Well, Ryan, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thanks for having me, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.